Welcome to our Three Corners Capital 2026 Virtual Investment Forum. We're excited that you'll be listening in, and today is a great lineup. We host these forums virtually now because our practice continues to grow, and that's a large part thanks to our clients who continue to refer us. But these forums allow us the ability to make sure that more people get to participate. And it also gives us an opportunity to alleviate some of the complexities of coordinating people from all over the country. So today we've got Cincinnati, Boston, and Laguna Beach, California represented. So our lineup today is great. And the goal that we have with these forums is to bring unique perspectives to our clients and guests. If you're like me, you see a lot of the same stuff on TV, in the paper, or on your social feeds. And this is an opportunity for us to help cut through the noise and bring ideas and thoughts that you might not be hearing or seeing from other sources. Uh, so what I'd like to do today is just first set a little bit of a framework. We won't be doing any live questions. If you do have or if you do have questions rather, as a follow-up, please reach out. We're happy to reach out to our partners for their take and give you ours as well. But I'd like to, in the interest of time, start to jump right into it by introducing our first speaker, Chris Morahan with Eaton Vance. Chris is going to kick us off with a high-level overview of markets and the economy. He's Managing Director, Institutional Portfolio Manager with Eaton Vance, and his role is to know products and portfolios across multiple strategies, especially equities, and responsible for communicating those insights. So, Chris, I'll let you go ahead and kick us off here today.
All right, thank you. Appreciate it. Good to speak with all of you today. I'm going to share some slides here. Hopefully those have come up. So just really trying to provide a little bit of a background on the economic backdrop that sets us up and what that means for U.S. equities. I think you'll hear about international equities a little bit later. But as we look at the setup with the U.S. economy going forward in 2026, there are quite a number of factors that are supportive of both continued economic growth and also supportive of continued profit growth, which we think will drive U.S. equities higher. So I'll just run through these very quickly. And as I do, keep in mind that a lot of these comments may not seem that way for individuals and their own experiences of the economy, but I'm really talking about at the aggregate level, looking at statistics. So to give you an example, one of the things that we've seen over the last year is the consumer survey data has been as low as it's been in 10 years. Really negative outlook for the economy, whether it's the University of Michigan sentiment or the Conference Board sentiment surveys. Extremely low readings. On the other hand, consumer spending has grown pretty stably like it has every year. So there's a bit of a disconnect between what we're seeing in actual numbers at the macro level and what individual clients like yourself, friends, family members might be feeling about the economy. So starting off with the first one here, Fed policy. Obviously, we had a couple interest rate cuts at the end of last year. We have a new chairman of the Fed starting as soon as he gets confirmed. So this is going to continue to be something that we're watching very closely. We do feel that even if there are no further cuts in 2026, and in January they declined to cut, that the cuts from 2025 will continue to make their way through the economy with positive impact on economic activity. The second would be fiscal policy. Obviously, the Trump administration passed their signature budget spending bill in July of last year. That is slated to provide $170 billion of consumer spending stimulus in 26 as a result of the various tax provisions that were in there. So no tax on tips, no tax on overtime, state and local deduction limitations, et cetera. So 170 billion of new spending that we didn't have last year should be positive for economic growth. Trade policy, obviously, it was turbulent last year with all of the tariff announcements and changes. But as that has been absorbed into the market, as companies and countries have adapted, we're going to be sort of annualizing that period and moving forward without additional major tariff headwinds coming, in our opinion. And then finally, deregulation. The U.S. Financial system has a tremendous amount of capital on balance sheets that we could see released into the market and the economy if there is some deregulation. It's a very vague thing to talk about, deregulation. What does that mean in practice? We had a CEO in our office from a major financial institution a few months ago, and they said that over 2023 and 2024, they had to hire 2,000 lawyers to meet all of their legal and regulatory demand for reporting. We don't think that they'll have to fire those 2,000 lawyers, but they probably won't need to add another 2,000 every 2 years as a result. So to the extent you have deregulation, that will be supportive for growth and for company profits. If we look at some of the major metrics for the economy, unemployment rate around 4.5%. When I studied economics in college, the natural rate of unemployment was 5%. So, while it has moved up from 3.7 or so, certainly not a problematic level to be concerned about. That being said, we just had a number come out this morning that the layoffs number was double what it was last January and was the worst January in about 15 years. So certainly not a rosy picture from an employment perspective, but with an unemployment rate at 4.5%, we're still comfortably not feeling a major employment disruption. And then when we look at GDP growth, very solid last year, despite the government shutdown, which you can see reflected in that 4Q 2025 number. And getting back to about 2%, not gangbusters growth, but certainly positive enough to keep the economy churning in the right direction. One of the things, one of the other headline numbers is inflation. How is inflation looking in 2026? We're in a range of about 2.5 to 2.7%, which is not very far off the 2% target. But I think the issue for a lot of people, individuals, including myself, has been, well, it's 2.7 on top of higher inflation the year before and higher inflation the year before that. So it's a collective building of the price level, and this is where we're seeing the significant focus on affordability with housing prices, with healthcare costs, et cetera. This slide just touches on tariffs and recognizes that the consumer has borne a lot of the pass-through in tariffs, and you can really see that if I skip ahead and show you what margins for U.S. companies look like. Despite the tariffs coming in last year, profit margins at U.S. companies have continued to expand. So, these are inflation, tariffs continue to be a story that we need to watch. But again, if you look at the continued march higher of consumer spending, we're not seeing it being an insurmountable obstacle. And with midterm elections coming this year, there will likely be a really significant focus on continuing to try to bring inflation lower. And maybe this one's a great one to connect the economy to the U.S. equity market. So we're in the second year of a presidential cycle. The chart on the left shows you the average return for every year of a presidential cycle. Interestingly, the average year one performance is about 17%. The S&P 500 was up about 18% last year. So really in line with that historical trend. But you can see that year two, the year that we're in, is by far the worst year of a presidential cycle, typically for the S&P 500. So the other thing to note is if you look at the chart on the right, is that second year typically has the largest drawdown, intra-year drawdown, but also has the greatest recovery after the midterm election. So, the message from this page is, the economic picture continues to look positive. You have the vast majority of strategists calling for double-digit returns from U.S. equities, much like they were last year. And so, it may seem like it's all clear, everything's coming up roses for 2026, but keep in mind that, generally, on average, we do get a 10% pullback in any year, but the average drawdown in second year of a presidential cycle is closer to 18-19%. So bottom line is, we think that the environment remains positive. Earnings growth is very strong. Valuation has not expanded, but margins have expanded. But we do foresee significant volatility in 2026, not just because of the year of the presidential cycle, but also, given what we're seeing in terms of, geopolitical developments, as well as, the current AI build out and investment cycle. So expect more volatility, but overall, we view the environment to be somewhat positive from an investment perspective. Again, that might be very different from, the individual person on the street that you speak to who may not view the outlook as positive based on inflation, based on layoffs, et cetera. So, Chris, I'll stop there and see if you have any questions.
Great. Yeah. I think, a big question that we talk about with clients around the economy is, and it's been made obviously very public and political in terms of, the Fed appointment, but also just in terms of inflation and interest rates. I'm just curious if you and Tom, I know it might be part of your slide too, but in presentation, so we can, you can welcome to chime in prematurely as well. But just in terms of, there's so much talk about bringing, the rates down, and then while in the short end has already come down pretty significantly, and it's really when you look at consumer impact, it's more at the longer end, like the 10-year, that has an impact. So I'm just curious if maybe you have any, comments that you'd like to make in terms of the role of the Fed, and kind of where we are and what it might take to get, the long term or the longer duration parts of the curve down.
Yeah, you're absolutely right. During this rate cutting cycle, the 10-year, I believe, is up about, close to 100 basis points over that period. So the short rates have been coming down. In the 10-year, the one that, mortgage rates key off of, for example, hasn't been helpful. So, obviously, and I'm sure a later speaker will touch on this specifically on fixed income, but absolutely the 10-year is what's going to really matter for companies. That's what, that's the rate that we're going to be keying off for, discounting future cash flows, et cetera. There's obviously a lot of different dynamics. If foreign countries decide to start buying fewer treasuries, that could obviously raise rates. So it's going to be very difficult to bring longer term rates down, but clearly remains an important focus for the administration and for the Federal Reserve.
Yeah, certainly, Chris. We'll see what happens with that. Wanted to ask, another thing that a lot of people are asking about and we're hearing about in the news is around artificial intelligence and whether or not that's going to lead to, significant productivity gains in the economy. From what I'm hearing, what we're hearing is, there have been some green shoots of productivity increasing, whether that's from AI or not, I'm not sure, but wanted to get your thoughts on that issue.
Yeah, so this chart right here, I think, is supportive of AI helping with productivity. If you look at 2025, this is the gross margin for companies in the S&P 500. If you look at 2025, a year where the average tariff rate went from 2% to 15%, so obviously impacting these companies and would seem to impact their margins increased over the year. And so, I think artificial intelligence is one of the drivers of that. It doesn't tell the whole story, but that's clearly a component. I seem to recall a comment from Amazon that we can double our business in 3 years without hiring another person. So clearly some companies are feeling it. There is, I think I had a page in here. Yeah, so this just shows how much more companies are talking about AI as a tailwind, as a productivity benefit. Now it's possible that, like in the dot-com period, they're just saying AI and hoping they'll get more support and excitement around their stock. But clearly, when you look at the number of companies talking about it, emphasizing it, investing in it, I would say you're right. We haven't seen a ton of examples of, okay, looking back at 2025, here's how much AI boosted our business. We're still in the build out phase. I know our company started using it a lot more in the summer of this year, so we don't even have a full year to try and measure. So it's probably going to take a while. But I think the thing to watch here from an equity investor perspective in the US is a transition from AI infrastructure and the build out to the AI beneficiaries. So a company that can use AI in its operations in order to continue to improve profit margins, reach more customers, maximize return on investment from their advertisements, et cetera. I think it's still early to declare victory for these companies, but certainly that's something to watch, that transition going forward.
Great, thanks. And that's a good segue into, continuing to talk about equities and the impact of AI, but also just the broadening of stocks and not just here in the United States, but abroad. So I'd like to bring up Andrew Buchanan with WCM Investment Management, who's going to be discussing primarily investing in stocks outside of the United States, but has a lot of great insight that I know is relevant regardless. And I would just also like to acknowledge that Andrew is a humble person, but he has military service in the SEALs, and just want to thank you first before you present, Andrew, for your service.
Thank you, and it's my pleasure. I think going through SEAL training was a good prerequisite for talking about international equities these days, right? Toughen up your skin. But thank you very much. I appreciate all of you having me on here. What I want to do is, so I work with WCM. We're based out of Laguna Beach. We are an international boutique. That is it. That is all we do. That is all we care to do. We've been doing this for a very long time. We kind of developed a niche and an expertise, and we've been able to exploit it pretty successfully on behalf of our clients and shareholders over a long period of time. What I'd love to do today is really just talk about the tailwinds that are supporting international. Obviously, I had a great year last year. But I also understand people who are probably listening to this. I know the narrative, right? Why do we even need international? International's been horrible for the last 15 years. Or the newest one I get is, hey, congratulations, you guys finally had a great year last year, your day in the sun. But why is it going to persist, right? Why is it not a one and done? Why is this going to continue? And I really want to key in on those. If you look at this slide, companies, not countries, right? This is this is words we live by here, right? There's this, I like to joke when I talk to people, I'll often get a question of, hey, what is your guys' Latin American utility exposure? What do you think about those? And my response is always, who cares? What does it matter, right? You're completely focused on the wrong things, right? We are trying to find you some of the best companies in the world that are very good at what they do that just aren't domiciled here in the US, right? There's three things I like to talk about. There are industries and businesses that we don't do here in the US. There are businesses and industries where we used to be the best, but we're not anymore. And there are businesses or industries where maybe we are the best or the market leader, but there's a whole nother component to the story, whether the distribution, the manufacturing is done outside of the US, whatever it may be. So we're really trying to be a puzzle piece for you. I'll often use the term, we're trying to find some of those air pockets to complement what it is you're doing on the US side of your portfolio. So let's talk about what are the, why is this international run here going to persist? These are probably, there's six big things here I'm going to point to, and I'm going to unpack these very quickly for you. Number one, the valuation story on non-US stocks. Number two, the existing currency backdrop. This is the strength or weakness of the US dollar. Number three, the concentration risk, which I believe was mentioned earlier about the narrowness of the US market, right? Everybody knows too much of the S&Ps and the Mag 7 and all these things. It's got to widen out. Number four, the differentiated exposures you will get outside of the US. Number five, and I'll spend a little more time on this one. There are some interesting country-specific catalysts going on right now that we think are incredibly supportive of this tailwind. And lastly, there are some dynamics in emerging markets currently happening that are also going to be beneficial. So valuation. Listen, this is a bit of a tired explanation. I'm sure Chris and Steve will tell you that they've had other asset managers coming in for probably well over 10 years, telling them to back up the truck. International's cheap. Now's the time, right? Probably started in around 2014. Probably about 7 years ago, they told them to leave them alone, right? Their thesis doesn't seem to be playing out, right? And I get it. And that is a reality. But why is that? If international has been so attractive from a relative price perspective, why has it not turned a corner? Why has there not been investment? Well, I kind of point to at its most rudimentary level, stocks are really a function of these two. Stock price is really a function of these two things. Your earnings growth. Do you have acceleration on your earnings growth? That's kind of the fundamentals of the company doing better. And the second component or lever to that stock price is multiple expansion. This is market perception. It's seen as higher quality, less risky. It's not as crowded of a trade, or people are so excited about the future prospective earnings growth, they're willing to pay a higher multiple for that company because of what they think is going to happen. If I may, I'm going to use a golf analogy here because people seem to like it. Earnings growth is you becoming a better golfer, right? You go to the range, you hit more balls, you're getting better. Your handicap drops from a 20 down to a 15, down to a 10. You become a better golfer. That's kind of the earnings growth component. The multiple expansion is like having to play on a harder course again and again and again. Now you're playing on this course with trees and water and you're hitting into a headwind. You've got these small protected greens. You're like, my goodness, I've been working away, becoming a better golfer, but I can't seem to score any better because you're playing harder courses. That is basically what has happened. There are plenty of companies international now, not the whole index, but there are select companies that have had fabulous and continue to have fabulous earnings growth. But we have been playing on an absolutely brutal course with wind and trees and water and everything else. That is changing, and that is what gets us exciting. And I'm going to talk a little bit about that. And just for those of you on the call who are like, oh, we missed the international run, or I'm going to wait for a pullback till I allocate. I'm going to show you the big seismic year we had last year. There it is right there. Right. So I like to joke, take a breather, relax, right? This problem didn't happen overnight. It took 15, 20 years for non-international or international stocks to dig this hole. It's not going to fix itself overnight either, right? So there's some long thematic tailwinds here. That's number one. Number two would be the currency. I'm sure everybody is aware, or maybe not. We've been in a strong dollar regime for well over a decade, probably about 15 years. It started to soften of late. But for those of you who are unaware, typically currency cycles will last about 10 years. And we were, 15 years in. So we were well into overtime or extra innings or whatever analogy you like to use. Okay, great. But hey, WCM, is this going to continue, right? That's what you want to know. Is this dollar going to continue to weaken? We would say yes. And here's why. I think it's safe to say our existing president, Mr. Trump, whoever the new Fed chairman is going to get clubbed over the head until they reduce interest rates further. I think that is a foregone conclusion. So you have the U.S. being more accommodative in loosening monetary policy, where you have Europe is basically neutral. They're right where they want to be, and they actually have inflation in check. Energy is a little sticky, but by and large, they have inflation in check and rates where they want them. Japan is neutral. They have rates where they want them to actually maybe looking to tighten to cool down that economy. So at its most rudimentary level, when you have Europe neutral and Japan neutral to maybe tightening and the U.S. being accommodative, that's kind of a classic recipe for a continued softening of the dollar. We're not calling for it to fall off of a shelf, but we are calling for that trend to persist and continue. That is a massive tailwind for any unhedged international investor. Number three, this is the concentration risk. There's too much capital in the Mag 7. It makes up too much of the S&P. The market needs to broaden out. We would agree with that. It's already started to broaden out, as you've seen. Will U.S. small caps be a benefactor of that? Probably so. For the exact same rationale, international will be a benefactor of that widening out trade as well, right? Less crowded trade, better valuations. So for the same reasons U.S. small caps might do well, international is going to do well also. Number four, the sector and style exposures. So if you look here at the bottom, right, this is in the dark green, information technology. You have about 35% of the S&P is tech-related sector. Well, if you go up one and you see the dark green and comm services is at about 10%, well, what's in that? That's Meta, right? That's Meta. Okay, go up another one, consumer discretionary, another 10%. What's in that? That's Amazon, right? So there's all these other companies that are effectively, technology companies. When you really diagnose the S&P or the domestic market, well over half of it is heavily tech related. Which has been great the last 10 to 15 years. But as you see the shifting and widening out, you have to get exposures elsewhere. So you're going to get a much better backdrop internationally, heavy in the financials. I'm not sitting here insinuating that we're looking to load up on big, cruddy European banks that are overregulated and can't grow. That is not our strike zone. But I would tell you in the financials outside of the U.S., there's a lot of amazing fintech companies. There are some amazing high-end private wealth financial companies in India, in the Middle East, particularly in Singapore. And that's where we're trying to selectively find those really attractive growth stories. One other comment on here is the value and growth dispersion. So last year, this is the EFA, but if you look at the ACWI XUS, international value outperformed international growth by about 1,500 basis points or 15%. That's a pretty big spread. Why is that? Well, it's pretty typical when you have these cycles turn over and everybody goes, oh boy, time to get into international. I've been underweight or I've been underexposed, and they start to shift. Well, what does everybody look for? They look for the most compressed or coiled spring. What's the cheapest stock I can find? How about those crappy European banks, right, that are overregulated and don't grow, right? So they start piling into those. The European Bank Index was up over 85% last year, right? So they're finding the cheapest thing. It's kind of a trade almost. You buy it at 5, it goes to 15. Great, I captured that. Well, now what, right? Because it's not growing. So now I got to figure out what I'm going to do next. So we would venture to tell you that as these tailwinds persist, we would expect in 26, we'd expect to see value and growth probably playing out and have those returns a little more equalized in 26. And as this persists in 27 and 28, I think you'll see growth maybe start to take the lead. That would be our expectations. Number 5, I'll spend a little more time on this one. This is some country-specific catalysts, right? So Japan had a great year last year. There's some massive corporate restructuring that's going on in Japan. It's been a big benefactor to those indexes, those investments. But Europe's always the big one I get, right? Everybody, when I travel and talk to people, they're like, what are Europeans good at, right? Other than making chocolate and wine and fancy leather handbags. They're pretty good at that. So, but what else are they good at? Well, they've had some issues, right? And they've really struggled. And this has been, but there are, I'll call it 5 major structural themes underway. And I'm going to give this caveat. There is execution risk here, right? They have to execute on this, but we have not seen things aligned for the European economy to be able to do what it needs to do. This is as good as we've seen it as far as a setup. They need to execute, to be sure, and we'll see what happens. But this is as good a setup as we've seen in our careers. So number 1, I talked about that overregulation, right? The European continent has had a wet blanket of overregulation draped over them for well over 2 decades. And anybody certainly knows here, you cannot grow a business when you have that much overregulation draped over you, right? It's impossible to grow. Well, they have kind of recognized that if they don't wake up, I'm not insinuating that Europe's going to become some deregulated free-for-all, but if they don't get rid of a lot of this just nonsensical excess regulation, Europe has now realized that they will never, ever compete again against the US or the Asia-Pac economies. They're going to be stuck in the middle like a bad sandwich. They're going to get bullied around, get told what to do, and they'll be price takers, not price givers. And so they've realized this. They have woken. I call it the European awakening. So they're already underway stripping away a lot of regulation, number 1. Number 2, the European defense and aerospace play. I like to say Trump kind of grabbed them by the shirt collars and shook them around and said, listen, you guys are on your own, right? We're not going to defend you against a Russian incursion anymore. And you guys got to protect yourselves, right? So, if you want to send bombs and drones and tanks into Ukraine, you have 2 options as far as he's concerned. You can build it yourself and do whatever you want. Or number 2, if you need our technology, we'll provide it, but you're going to buy it. We're not giving it away anymore. Germany, you can buy it, or NATO, you as a group, you can buy it, but we're not giving it away for free anymore. So Europe has realized, holy cow, we need to start investing in our defense and protect ourselves. And this has been a massive. So if you look at any German defense name, just shot out of a cannon last year. That is not a 12 to 18 month theme. You're talking probably no less than a decade minimum to build out an entire defense apparatus, taking care of that continent. Number 3, fiscal expansion. For those of you unaware, at the end of World War II, there was the Potsdam Treaty, which by and large kind of prohibited Germany, the largest economic engine in Europe, prevented them from deficit spending on defense and in large part infrastructure build out. They were hampered. They couldn't do it. About a year, this happened pretty quietly. Not as many people recognize, certainly in the US, that this happened. But about a year and a half ago, the German Bundestag, which is their Congress, had to physically change their constitution, and it required a 2/3 vote, and it flew right through. They had to physically change their constitution to finally be able to deficit spend and build out this defense and infrastructure build out. That is massive. That is a massive catalyst for the European continent. Here in the U.S., we like to borrow and invest and grow, right? And it's worked for us. We like to have a high credit card balance, right? But it's worked for us, and we've invested and grown, and it's been successful. I like to joke, Germany's kind of like your crazy uncle who pays cash for everything, right? They're 65% debt to equity, so they're chronically under-levered, but that is changing. That is a massive, massive catalyst. Monetary policy, I already talked about that, kind of stable where they want it. And then lastly is capital allocation. At its most rudimentary level, when you think about business principles, there's really only 2 things you can do with free cash flow. You either reinvest it in the company to grow, Now, there's a myriad of ways you can do that. You can engage in M&A and share buybacks or organic growth and hire people, but it's all reinvesting to grow. Or you have to kick it out the side door in the form of the dividend. That's it. Principally, those are the two things you can do. For those of you unaware, Europe has always reflexively done the latter. This is why people think of it as a big value market. They would take all that free cash, shove most of it out the side door in the form of a dividend. You'd get a big fat check in your mailbox, and there was nothing left to plow back into the company to grow. Hence, their share price went sideways for a decade. And everybody goes, I hate international equities. Of course you do, right? Other than the check you get in the mailbox, they're not growing. So it's understandable. That is changing, right? And these are all kind of working together, right? So the CEOs of these organizations are like, listen, we promise we're going to take the free cash and reinvest and grow responsibly. But hey, Mr. Politician, we need your help getting rid of some of this regulation, and we need you to clear the deck plate so we can invest in defense, pass what laws you need to do. Let's get let's get the monetary policy in line with what we need to do. And so it's all kind of working together. Again, execution risk, but things are teed up as good as we've ever seen them. With that, I would just quickly highlight, and I got one more slide here. With that backdrop, what do we like? These are probably the five big themes that I see that we really are kind of leaning into. So while we don't care about geography and sector and we just pick stocks, what we will do at WCM is find a handful of themes that we get very, very excited about. I referenced the European defense play. Aerospace is kind of an offshoot of that. Healthcare has been widely ignored for a while. Frankly, in large part because everybody's just been piling into AI stocks. There's some really, really innovative healthcare stocks outside of the US. Artificial intelligence, we all know about that. What I would tell you is, broadly speaking, the US is the largest consumer and the best developer of artificial intelligence apparatus. I know China's trying to compete with us. For now, this is where you come. But a lot of the manufacturing, the downstream picks and shovels part of the AI play happens outside of the US. There's a company called Taiwan Semiconductor. I'm sure many of you have maybe heard of them. They own 85% of the global advanced semiconductor chip manufacturing in the world. That is ridiculous, right? I mean, you want to talk about an unbelievable moat. I'm going to make a comment here, and you're welcome to agree or disagree. It's controversial. I would venture to say, if Taiwan Semiconductor was a U.S. company based out of, I don't know, Sandusky, Ohio, it would probably be the most valuable company in the world, and it wouldn't even be close. But it's not. It's based out of Taiwan. China's going to invade Taiwan. Everybody gets concerned. So there's a discount that gets applied, as it probably should. But these are the types of industries and businesses that are outside of the U.S. that you have to have exposure to that. We think Taiwan Semiconductor, if you believe in this AI boom, is probably the most important company in the world that you have to own, in our opinion. And then lastly, just electrification and data centers. Everybody knows this. We can't build the data centers here fast enough for the AI, boom, and we got to electrify them, and we have to, cool them with water and air conditioning and all that. Europe has the same issue, right? So the same kind of issues. And then lastly, emerging markets. They are historically cheap. They're versus the S&P. This is kind of a Captain Obvious slide here. Everybody knows that, of course. That's not the point of my slide. The point of this slide, to me, is that I think it's fair to say that our current president is doing everything he can to shake this globalist world order to its foundation, right? He wants to break it up and kind of restart and rejigger everything. That creates tremendous volatility, right? It's like taking your chessboard and just throwing all the pieces up in the air, and everything's up in the air, and it creates volatility, and people are concerned. And you've got countries where Trump says, 30% tariff, right, on all your wine, you say. And then the next day he goes, I'm just kidding. You're good. We're good. And then the following week he goes, check that 20%, right? And these countries are like, you've got to be kidding me. Like, how do we work with you? How do we trade with you when you're so volatile and unpredictable? Now, they're still going to trade with the U.S., and they have to in a large part. But what I'm telling you is many of these countries are like, hey, listen, we better have a backup plan. We better have other countries that we're importing with, exporting with. We need to have backup supply chains. whom we're going to buy oil from, who we're going to buy, this from. And so it's creating all these other relationships and supply chains, and it's chaos right now. And if you're smart and can and be calm and assess kind of what's going on, volatility creates tremendous opportunity. And probably one of the biggest benefactors of that volatility and chaos will be a lot of emerging market jurisdictions. So with that, I think I'm right on about 20 minutes. I'm going to stop sharing and I'm going to turn it back to you, Chris, and I'm happy to answer any questions.
Yeah, thanks. I think I'll have one question, and then we'll finish with Tom, and then maybe conclude with a couple collective questions. But one of the things that WCM does unique, and I really think is something maybe just to highlight, is on culture. And when people hear that, they may have different connotations, and I think it'd be really good to hear from you. And one of the things I'd like to just say as we lead into a comment that you might make on that is last year in 25, Gallup does their annual state of the workforce survey, and they found in 2025 in their 2025 survey that 17% of U.S. workers wake up going to work with a conscious effort to they call it actively disengaged, which means that they're literally waking up not just unhappy, but literally wanting to go to work to sabotage their team, to sabotage the work. So active disengagement. Only 30% or so of the U.S. workforce is going to work actively engaged, feeling like, hey, I want to be a productive member of this team. So that means you've got two-thirds of our workforce showing up at worst case actively disengaged, but at least at a minimum disengaged. So I'm just kind of curious if you want to just chime in with why culture might be important and how people might hear that and get it wrong.
Yeah, I would love to. That's shocking. I haven't heard that statistic, but doesn't surprise me, though. I will say that. So WCM, why culture matters. This is one of the three big things that we do. We're very unique in the way we manage money here. We're very not traditional. I will say that. And one of the big pillars we do is we have full-time culture analysts at our firm. They don't care about balance sheets. They don't care about EBITDA of companies. They sit sidecar with the more traditional analysts, and their only job is to rip open the hood of these companies and figure out from a cultural perspective what drives this organization and are the right elements in place that are going to support whatever beautiful growth trajectory or competitive advantages this company built. Is it supportive of helping that to continue to grow? Often we'll get, hey, are you looking for like cool companies where they let you wear flip-flops and play foosball? No. That's the misnomer. That's not what we're looking for. I would say on the screen there's three big things we're looking for, and they're highlighted in green. Number one, culture strategy alignment. Said differently, is it the right type of culture in place at that company for that type of organization? Meaning the type of culture we'd want to see at a retailer like a Starbucks, where it's very consumer driven and it's a commodity. You can get a cup of coffee anywhere, right? So it's all about the experience. The type of culture we'd want to see at a company like Starbucks is very, very different than the kind of culture we'd want to see at a long haul trucking company or precision railroad, right? Number two, the strength and durability of that culture. Does it truly permeate the entire organization? And when you think about this, I'm going to use a military analogy, if I may. There was something in special operations we used to call commander's intent, right? This is the big general or the admiral, commander's intent. What is it you want to have happen, sir? Right? I want the hostages out of the building. I want you to get rid of the bad guys, blow the building up, be on the helicopter at 0200. Roger that, sir. We start from there and we would reverse engineer the planning. That's how we do it in the military. It's very backwards, right? We start with the end state and we reverse engineer the plan. This is no different than if we meet with executives of a company and we say, hey, what is your plan to compete against your competitors, to take market share, to steal clients, whatever, to grow? Now, if we disagree with their rationale on how they're going to do that, well, then we're certainly not going to invest. But if we principally agree with what those executives, how they're going to grow the business and compete, when you can step on the other side of that fence line and it is crystal clear that everyone in that entire organization, there is zero daylight between their expectations of what's expected of them to accomplish that mission, and everybody's fully in lockstep, paddling the boat in the same direction, whatever analogy you want to use. You can't ask for anything better in this industry, right? You agree with the vision of the executives, how they're going to grow. You can look on the other side and it is crystal clear. Everybody's locked in and they know exactly what they got to do. And then the last is around adaptability. If you have, listen, 99.9% of the time, if you're a big successful company, you probably used to be a very successful smaller company at one point that probably had some amazing culture that made you who you are. But how do you hold on to that amazing culture that made you so special in the early days as you grow rapidly? It is not easy. It is incredibly difficult, but there are companies out there that have done a good job over time, holding on to as much of it as they could. The punchline here is that when our culture analysts get 3 green check marks or 3 green lights, whatever you want to call it, in those areas, what we have found is that the correlation between that and high levels of sustained operating excellence is off the charts high, absolutely off the charts. And at the end of the day, that's what you're looking for. How do I find this company that has growing competitive advantages and there's a culture driving it that we think can help that persist over some period of time through a myriad of cycles? That's the riddle of this whole game. And said simply, culture is probably the best tool or lens that we have ever found. And we've tried everything, I assure you. It's probably the best lens or tool we've ever found that gets us comfortable that this is either going to persist or not persist. And that's kind of how we've wrapped culture into that.
Oh, great. Thanks so much for sharing that. It's just something that doesn't oftentimes get talked about, but it's a really important factor.
Yeah.
And so, last but not least, I'd like to introduce Tom Spicer with Wellington Management. He's going to bring over 14 years with the firm to talk about the fixed income landscape in particular. And so, Tom, I'd like to turn it over to you.
Thanks, Chris. Thanks, Steve. Thanks for having me on, and thanks everyone for spending some time with us today. So, when you think about the fixed income markets, and Chris had mentioned a couple of these points. I think what you have to pay attention to is that we're expecting the markets to continue to be very volatile going forward. We've seen this over the last couple of years. We expect this to continue. There's a number of reasons for that, some of which have been touched on. But the important thing is that as you're thinking about how to navigate these fixed income markets, you have to do it with strategies that have a lot of flexibility. Because you are going to see a tremendous amount of volatility. So where are we seeing the volatility? And like I said, some of these have already been mentioned. Geopolitical, it's been a big area. We're hearing about it every day, whether it's Russia, Ukraine, whether it's Taiwan, even Greenland. You're seeing a tremendous amount of geopolitical pressure that's going back and forth. And the markets react to that to a certain degree. Inflation's been a big area that we've talked about. We'll continue to talk about that. A lot of it's been related to tariffs, and that's still an ongoing discussion that you see on an everyday basis. Deficits is something that I think a lot of people are very concerned about, especially here in the US, but other places around the world. And then, more importantly here in the US, and it's been touched on, is cracks in the AI story. It's been a major driver in the economies. We think it's going to continue to be a major driver in the economies. But as you've seen just in the last couple of weeks, a lot of these stories are priced to perfection. And if you see little cracks, even though the numbers, they're seeming to coming out and beating revenue guidance, they're beating earnings guidance, even if they're not to the perfected levels that the market's expecting, you're seeing cracks in that story. So I think you're going to continue to see this volatility. You're going to continue to see a lot of market dislocation. And that's why it's important to have strategies that have a tremendous amount of flexibility around them. So let's talk a little bit about fixed income and where we're currently seeing. And like I said, Chris mentioned some of these things, and I would say we agree with most of what he was saying. So when it comes to the markets, I think you have to pay attention to interest rates and the factors that are influencing interest rates and what interest rates are going to do. because that's a big component of fixed income returns. And by the way, fixed income is going to be an important part of your overall portfolio. When we talk about all of the things that are going on, both in the US markets and in the international markets, the volatility that goes with them, the valuations that we're seeing, fixed income and can act as that ballast in your portfolio to really offset some of that volatility. Not to mention it provides a decent income. And, unlike in the last several years, there's income back in fixed income, which is great to see. You actually have yields in fixed income that can provide that cushion from that volatility. So, but when you think about rates and what our expectations for rates are, and remember here in the US, and Andrew mentioned some of these here in the U.S. We've had kind of a start-stop, right, with lowering interest rates. We've been in a more accommodative policy. This goes all the way back to the fall of 24, where we got in several cuts, but then we put on pause. The Fed was on pause for most of 2025 because of concerns of inflation. Inflation was sticky and high. Remember that the Fed has a dual mandate: a certain level of inflation, which is typically targeted right around 2%, and then a full level of employment. Those are their two mandates that they're trying to accomplish, and finding that balance between them. Inflation has been one of those areas that was sticky and was causing them not to be as accommodative, not to drop interest rates as aggressively. As you started moving through 2025, employment started taking a larger and larger seat at their decision. And as you moved into the summer of 2025 and saw some of the employment, especially in the lower income employees, start to come into pressure, that's when they decided to get back and start lowering interest rates again. They got another 3 cuts or so in, and now just more recently, they've put on pause again, right? They're trying to find that proper balance, that right level of accommodation, that right level of restrictiveness, and they're trying to balance that with what's going on in the economy. Our view is that, and what the market's pricing in right now is, although they're on pause right now, that they might get 1 or 2 more cuts in as you move through 2025. And we'll come back to that a little bit later, because we do see some developments that we're paying attention to along those lines that maybe open up that option a little bit more. The other thing we wanted to touch on too was spreads. So this is the spread over treasuries that corporates are yielding. Spreads have been very tight. The valuations on corporates on credit has been relatively tight. It's not on all aspects of the market. There are still opportunities out there. And I think finding a strategy that can really tap on those areas of the market that show more of a risk return, a positive risk return trade-off, is incredibly important. So when you think about some of those areas, it's emerging market corporate. So I completely agree with Andrew when he's talking about emerging markets and the opportunities that are in emerging markets. Sure, they might be some scary neighborhoods, but these are good companies. The fundamentals are still very good. And in fact, I would say the fundamentals on most credit are incredibly good. It's more the valuations that have been more troubling. But emerging market corporates, a lot of opportunities there. Convertible bonds. You see a lot of opportunities with convertible bonds and being able to capture some of that equity upside, especially for some of these technology companies. We've talked a lot about AI and kind of the beneficiaries of AI. A lot of these technology companies, as they're hitting the markets, they're not necessarily just going to the equity markets, but they're hitting the corporate markets as well, the fixed income markets. Securitized, a lot of opportunities in securitized. These are asset-backed securities. So when you're thinking about car loans, subordinate car loans, things like that, that came into a lot of pressure last fall. That also opened up some opportunities. So we do see a lot of opportunities, and having that ability, that flexibility, that specialization to manage and navigate what's going to work is incredibly, incredibly important. Sector leadership, as I talked about, volatility in the marketplace, sector leadership will also be very volatile. If you look at a long-term chart showing all the different sectors of the fixed income markets, very rarely will you see the same participants outperforming or underperforming year after year after year. It changes around like crazy. It could be bank loans one year. It can be emerging market another year. It can be treasuries another year. It can be high yield. It can be investment grade. It can be securitized. They change around. And so being able to navigate and pick which areas of the marketplace you want to participate in, I think gives you a lot of flexibility. So those are all the things that we're talking about. We still see a lot of opportunities. We still see a lot of positive fundamentals in the fixed income markets. You just have to be able to navigate around the valuations. One thing that I will mention, and this differs a little bit from Chris, there is growing evidence that might open up the opportunity for rates to come down more than what the market is seeing right now. And I'm not talking a huge level of a combination being priced in, but instead of the 1 or 2 rate cuts that it's currently priced in, it could be 2 or 3 rate cuts. And the reason for that is when you think about the markets currently, there's a couple of factors at play that could actually lower inflation, that will be disinflationary to the markets. One is housing, right? It's hard for me. I come from the Northeast. I'm up in the Boston area. It seems like real estate has never gone down in my lifetime, but there actually is downward pressure on real estate, on rents. That's a big part of inflation. And if you see that to start come down, that could have kind of a lowering inflation aspect to it. When you think about the one big beautiful bill, there was talk about kind of the deregulation and the fiscal stimulus. We do believe that that's going to be firmly in place for the first half of the year, right up till midterms or so. After that, we think that fiscal impulse actually starts to fade quite rapidly. And again, that fiscal impulse to begin with might have some inflation components to it, but then it quickly turns and runs out, and you start to see disinflation. Oil prices. There's been a lot of talk about oil prices. Obviously, there was a lot of headlines around Venezuela. We think actually oil prices could actually soften and maybe come down a little bit. It will take some time. Venezuela is obviously a huge supplier, potential supplier of oil, but their infrastructure has been uninvested in for decades. It's going to take some time to bring that back around. But as you start seeing that happen, that incremental supply could put downward pressure on oil. And then lastly, about immigration, if you have slower population growth, our belief is that you do tend to have slower economic growth. That again will put downward pressure on inflation. Offsetting that is going to be a lot of these ideas about productivity, AI generated productivity, and will that counterbalance? And I think that's what we're paying a lot of attention to. And that's what the Fed's going to have to pay attention to, too. Obviously, you have a new Fed incoming chairman. We think he's a very credible candidate. He is very intelligent. He has a lot of experience. He has a lot of political connections. He's worked both in Wall Street and in the White House. So we think Kevin Warsh is actually a very solid candidate going forward. But he too has talked about lowering interest rates, especially in the short end, and how our economy needs that in order to stimulate growth. So we do believe it sets the stage for what potentially could be a surprise to the market as far as interest rates coming down a little bit further. As interest rates come down, bond prices go up. That would be good for the fixed income markets. Let me stop there and see if there's any questions along those lines.
Wow, that was great, Tom. That was a fantastic overview of the state of the global bond market, and really appreciate your comments, on the Fed and their dual mandate. I was going to ask you about, in the interest of time, kind of keep it quick, but there's been a lot of pressure on industrial metals, copper and so forth. We've heard about, gold and silver
Yep.
being, an industrial metal as well. That along with maybe some lingering tariff effects, uh, less employment could also be an uptick, pressure on wages, perhaps. So just kind of a little bit more your take on the metals
Yep.
boom in prices, and if that's just a temporary thing, or if you think that could be a big factor, maybe surprise the markets down the line.
Yeah, I mean, it's been a wild ride in the metals. I mean, you look at gold prices, you look at silver prices, others. It's been an amazingly wild ride. There's a couple of catalysts that are driving that right now. Inflationary pressures are one. I mean, that they constantly have an impact there. The whole safety idea, kind of this safe harbor, if you will, a lot of that used to be the dollar. A lot of that money is now shifting into areas like gold as being that safe haven status. So you see that going on. There's also a fair amount of actual fundamental demand for metals. When you think about the AI build out for gold, for silver, for copper, that's all having an impact on those areas. I think those were some of the fundamental drivers that were driving up the price of metals. I think more recently, what you've had is a little bit more of a speculative tone to it, in that people are trying to jump in on this momentum and they're seeing that. And those, that tends to be a little bit of quicker money. They can come in and out of the market relatively quickly. And that's why you're seeing such volatility. We do believe that there is that the fundamental demand drivers will still stay in place for the price of gold. I would have a hard time on a day-to-day basis picking exactly the time to jump in because it has been so volatile lately. But there is fundamental drivers to commodities going forward.
Yeah, for sure. Well, great stuff, everybody. Thank you very much. We really appreciate your time and your insights. In the interest of time, we'll wrap it up. But Chris, Andrew, Tom, you guys have been fantastic. And to our clients and guests, thank you very much for attending today. If you have any questions about the discussion or something that you want to talk about related to your personal portfolio or planning, please feel free to reach out. So thanks again, and everyone have a great day.